Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and the goal of my show is really simple: to learn from those who have mastered their craft. If you're new to my show, please be sure to hit that subscribe button. So today I am joined again by Ronald Stoeferle, a managing partner and fund manager at Incrementum AG. So Ronnie, without further ado, welcome back to the show.
Hi, Ben. How are you?
Really good, Ronnie. It's been a good summer, as we were chatting about earlier. And I know you've been watching a lot of the Europe Cup, which is now actually over.
But now is Olympics, so I really enjoy watching different types of sports that I usually don't really follow. I just love it. It's a great time to be a sports fan.
Since I last saw you, you came out with the 2024 In Gold We Trust report, and there was like a lot of content, I think over 400 pages. So if we could just start, what are the primary factors shaping the current status of gold, and how do we compare it to historical patterns?
We did it again. We wrote more than 400 pages about gold, and last year's title or the leitmotif of the In Gold We Trust report was Showdown, and we said there's a showdown happening when it comes to politics, East versus West, de-dollarization. There's a showdown when it comes to the economy. How much longer can the economy really deal with those high interest rate levels? And there's a showdown in the price of gold itself, because back then gold was still in this kind of sideways pattern and hasn't made new all-time highs in US dollar terms yet. So it has played out quite well, I have to say, over the last 12 months. And I would say, some of the highlights of this year's In Gold We Trust report are actually the fact that there's something going on in the gold world where many people kind of shook their head and say, well, why? We don't really understand what's going on. So one example for that would be the fact that real interest rates have risen significantly. So nominal interest rates were rising and inflation numbers were coming down. So this is normally the recipe for a big drawdown in gold. Gold still made new all-time highs, and it actually really broke out big time. So against all odds of surging real interest rates, gold did tremendously well. Then we're seeing that the Western financial investor, and we gauge that by ETF flows. The Western financial investor isn't really participating in this gold rally. So we're actually we have seen for most of this year, we have seen outflows from the gold ETFs. So we said, okay, what's going on actually? Yeah, it gold has kind of changed the rule book or the playbook. And this is why we came up with this leitmotif of the new gold playbook, where we say, okay, well, actually, there's things happening in the gold market um, that now really explain the price action. And I think two of the most important examples would be, first of all, the fact that the Western financial investor isn't the marginal gold buyer anymore. So the market is clearly and more being dominated by emerging market demand. So especially China, India, but also the Middle East. And the second thing is that central banks are now really a crucial player in the gold market. So we said, as an investor, you have to be flexible. You have to adopt to the new playbook. And this is what we're actually explaining in this year's report.
How has gold's performance compared, to these, stocks, bonds, and other commodities recently? And what does this reveal about the investor behavior?
Well, we made, when it comes to the tech stocks, and obviously finally they market participants realized that those tech stocks can also go down and not only up. And we made the comparison, saying that it's like watching kids playing soccer. It's, the whole pack is running after the ball like a bunch of chickens, basically. So there's no trace of tactical positioning or defensive work. Just like everyone is chasing the ball. And I think this is a pretty good analogy for what's going on in the tech space. So we have seen this enormous amount of FOMO, for fear of missing out. We've seen that until beginning of June. Nvidia was responsible for 25% of the whole profits in the S&P 500, and the Max 7 were responsible for 50% of all the gains in the S&P. So we have seen this enormous amount of concentration. So the 10 largest US stocks by market cap, they were actually responsible for 14% of total global market cap, which is significantly higher than in March 2000, where it was just 9.9%. So we have seen this extreme dynamic of concentration, but also of overvaluation and extremely positive sentiment. So this has obviously changed over the last couple of days with the unwinding of the carry trade, with lots of turbulence and volatility in the tech space, with many market participants basically reorganizing their portfolios into more of a defensive space, especially the utilities, but also more into the value space, even into the small cap space. And then I would say that the second big trend this year has been, or of the last 2 years basically, has been that government bonds are not being regarded as the anti-fragile portfolio foundation anymore. And they've been that for basically 40 years. But since the all-time highs in the bond market in the year 2020, the 100-year Austrian bond, this duration monster, it was actually down almost 70%. The 30-year US bonds, they were down almost 50%. So it seems that market participants are kind of realizing that that inflation will continue to be a topic. They are kind of realizing that the US debt policy is not sustainable, but it's not only US debt, obviously. It's we're seeing the same in Europe. And I would say that the bond market and also the gold market are basically sending the same message, and the message is inflation is the new reality. When it comes to commodities, as the third part of the comparison between gold and other asset classes, I would say that, first of all, 2021 and 22 were great years for commodity investments. 2023 was a poor year, down 12%, primarily, I would say, because of the weak economic engines in China and also in Europe, disinflation, and also rapidly rising interest rates. And so far this year, it seems that the market is also discounting more of a recessionary environment. And I think that with the ISM last week and also employment numbers, I think that the market is now realizing that not a soft landing or a Goldilocks scenario or a no landing should be discounted, but rather a recession, a hard landing. And I think this is really what now finally the market is starting to fear.
With global debt levels at record highs, what role does this play, for gold as a safe haven asset in this context?
Yeah, well, I mean, just since the year 2020, the US has basically added 11 trillion in new debt. So I think we are seeing high interest sensitivity with an implicit higher incentive to lower rates. And therefore, I think that the turbulence that we're currently seeing in markets is being quite welcomed by politicians and also by central bankers, because that will give them basically a reason to lower rates again. So just one number, Ben. I mean, we're the US is will be hitting 35 trillion over the next couple of days. Um, so those numbers are really staggering. And if rates should stay at the same level like they are at the moment, um, just US debt service costs will be 1.5 trillion next year. So at some point, those debt service costs will be higher than defense costs. And I think Neil Ferguson said this is like very, very critical, and has historically quite often been a turning point for great nations. Now, we're just seeing from that number, 1.5 trillion at a GDP in the US, which would be like 25 trillion probably this year, something around that. Those numbers are significant. And I think, um, it seems that no one really cares about deficits anymore, and everybody got so used about those numbers. But at some point, it will matter. And I think we're coming much, much, much closer to those numbers. And let's face it, we have seen that we went basically from monetary dominance to fiscal dominance. That's basically the main reason why the US hasn't entered a recession yet. This enormous amount of fiscal stimulus. And now I think we're basically moving into a direction where the marginal fiscal stimulus will probably continue to fall over the next couple of quarters, and I think this will have an impact. Now, therefore, I would say that one of the most contrarian views at the moment would be that interest rates will go basically to zero again. Is it my main scenario? No, but I think we shouldn't rule that out. And I was talking to a bond trader yesterday, and he said if you would say that rates will go back to zero, um, you're getting ridiculed if you're sitting in a big bank or a big institution. But I think we shouldn't rule that out actually, and that obviously could be the trigger for the next round of inflation, and could also be a main trigger for gold and the commodity space going forward.
How might gold serve as a hedge against inflation, and what are the report's predictions for future inflation trends?
Yeah, well, Ben, over the last couple of days, US 5-year break-even inflation rates have collapsed. They're at like 1.7, 1.8% at the moment. So um, I think this is one of the reasons why the Federal Reserve will have more leeway to lower rates. Yeah, because based on their framework, inflation is basically dead. They won the fight. But from my point of view, this is also due to some technical drivers, the base effect, also due to the fact that obviously recessions are always disinflationary or deflationary. Um, so it would be premature to say, okay, inflation, the whole inflation story is over. I think it will come back. There will be a sequel. Like nobody thought that there's gonna be a second Rocky movie or a second Rambo movie, and we all know how many sequels we've seen, and actually for Rocky, I think they even got better. Um, so so I think inflation will continue to be one of the most important things to consider for portfolio construction. Now, Ben, if we take a step back, we shouldn't forget that we've seen 40 years of falling inflation rates. So that was the so-called Great Moderation. And the Great Moderation meant like very low inflation volatility, rising bond prices, so falling yields, um, and pretty stable, I would say, macro volatility. So basically, market participants got used to the fact that central bankers are taking care of every crisis, the Fed put and so on. But now, from my point of view, I think this, first of all, this great moderation is over, due to some structural drivers like demographics, for example, but also deglobalization. I think it's we shouldn't forget that one of the big political and economic trends of the last 30, 40 years was basically that we were tearing down walls, and globalization was one of the largest disinflationary drivers in financial markets. And now it seems that the trend is going in the opposite direction. So that's definitely an inflationary driver. So I would say that inflation will continue to be very, very important for financial market participants. And I think that um, if we study, for example, historical inflationary episodes, um, it basically, first of all, I think one of the drivers was that it takes time to really get the inflation genie back into the bottle. And the second thing is that central banks will continue with their very asymmetrical policies. So they will, as they did previously, they will talk inflation down and will start hiking rates way too late. And then on the downside, they will say they will start lowering rates way too early, as soon as they think that inflation numbers are sustainably coming down. So this is kind of the playbook that I'm having on the inflation side. So long story short, I think now we're seeing some sort of a dampening effect on prices due to the recessionary clouds that are gathering, but I cannot rule out a new acceleration of inflation going forward.
And so, Ronnie, if we want to now master, this new gold playbook that came out this year, what are some strategies that you would recommend, for investors for navigating the evolving landscape of gold investment?
Yeah, well, we said that actually, in this new gold playbook, you have, if you want to master the new gold playbook, uh, it obviously also has consequences for your portfolio construction. And we're having a look at, let's say, our asset classes, which is gold, silver, commodities, and mining stocks, and we introduce our active aurum signal, which is basically a signal that is showing us um, if we should play more of a offense or more of a defense in the gold and in the mining space. Yeah, and um, the saying that offense wins games, but defense wins championships. But I think this also fits to the mining space, where I think we all know that they offer tremendous upside. But actually, if you're a long only manager and you don't get the cycle right, then you will still be experiencing a drawdown of 60, 70, 80% in a bear market. So this is really our approach to understand the cycle that we are currently in. And our active aurum signal is giving us a green signal at the moment. We explain the signals and the sub signals and the interpretation in our report, and that leads us to um, for the longer term to our new interpretation of the 60/40 portfolio. So the 60/40 portfolio was basically the holy grail of investing for the last let's say the last 40 years, primarily due to the fact that as I've said, great moderation, rising bond prices, correlation between bonds and equities. So in hindsight, the perfect portfolio construction was 60% stocks and 40% bonds, because bonds did tend to hedge, losses on the equity side. From our point of view, if inflation will remain a topic, and if markets will start questioning, the debt levels of industrialized nations, then we think we should perhaps reconsider this portfolio construction. So we come up with the new 60-40 portfolio, which would be still 45% stocks, then only 15% bonds, and perhaps more corporate bonds, more emerging market bonds. Then we would suggest 15% safe haven gold, which is physical gold stored in a safe jurisdiction. Um, this is a part of the portfolio where you shouldn't be, having a look at the price all the time. Yeah, this is really that you preferably inherit to the next generation. But then also 10% performance gold, which would be um, silver, for example, but also mining equities from the gold and silver mining space. This would be the portfolio, the performance part of gold, then 10% commodities and 5% Bitcoin. And so this would be our interpretation of the 60-40 portfolio. And we basically explain some risk numbers and some performance numbers that we have calculated in our research.
I appreciate that answer, Ronnie. And I just want to pinpoint to you on, you talked about Bitcoin, being part of the portfolio. So, gold and Bitcoin are talked about a lot. Sometimes there's a lot of interesting conversations about it. But if we could just focus on, Ronnie, how does the report compare gold and Bitcoin as an alternative assets in the current market?
Well, Ben, it's a very heated discussion. It's a very emotional discussion. So I always say, if I talk about gold, the audience, they either love it or they hate it. Yeah. So if I'm delivering a keynote, sometimes it's like it's not that underwear is being thrown on the stage. Yeah, and you probably don't want to see that. Yeah, it's not like at a rock concert. It's rather, I would say, like a older audience usually. But then there's also lots of people actually that really hate gold. I say, no, it doesn't pay any interest. Yeah, it's not productive and so on. From my point of view, emotion isn't the best advice when it comes to portfolio construction. Yeah, let's leave emotions out and have more emotions in, I don't know, personal relationships perhaps. Yeah, but not when it comes to investments. And interestingly, that the same applies for Bitcoin. It's a very heated discussion, very emotional. You either hate it or you love it. You're a Bitcoin maxi, or you're a normie, or I don't know all those terms. But from my point of view, there's many similarities when it comes to gold and Bitcoin, and probably the most important one is the high stock to flow ratio. Um, and what we do in the report, for example, and we started writing about Bitcoin already in 2017, and we run two funds that actually combine gold and Bitcoin. Um, where we got lots of criticism, but actually, just have a look at the numbers. They're staggering. Really, really great performance in those two funds. Um, so so we like both monetary assets, and of course, gold is around for more than 5,000 years, while Bitcoin is basically a teenager. And teenagers tend to be, let's say, volatile or wild, and different to grown-ups, but I think that Bitcoin has made enormous progress over the last couple of months, especially with the Bitcoin ETFs now in the United States. But I think what's really important going forward is basically that if we have a look at the supply, the future supply. Let's have a look. For example, that's Lynn Alden had that in one of her newsletters. So, in this era of fiscal dominance, we're seeing that the CBO, the Congressional Budget Office, is expecting or forecasting over the next 10 years, 20 trillion of further US government debt. And this is pretty optimistic. And in their forecasts, in their scenarios, they say that there will be no recession over the next 10 years and no major financial crisis. So probably the number will be significantly higher. But let's do 20 trillion. In contrast to that, the amount of newly mined gold will only reach at current prices 2.5 trillion over the next 10 years if the production rate remains constant. And this production rate has been pretty stable over the last 100 years. It was always between 1.5 and 1.8%. So 2.5 trillion of new gold being mined over the next 10 years at current prices. When it comes to Bitcoin, the supply of Bitcoin over the next 10 years will be 1 million Bitcoin, and I think 1,025,000 will be mined. So at a current price level at, let's say, 60,000, that will roughly be 60 billion US dollars over the next 10 years at current prices. So I think if you compare this relative scarcity of gold and Bitcoin versus US debt, and US debt is, I think, 32% of the whole total world government debt, you can see that actually those are very, very scarce assets. And I would say that price actually has to solve that. So I'm super, super bullish on both assets. And I would say, and this is going to be one of the key takeaways of my new keynote that I'm currently preparing. Gold is still dirt cheap at current levels, and if I say that in an interview, people will say you're crazy. Now we're trading at almost $2,500, and you're telling me that gold is cheap at these levels? Yeah, I think so. Relative to many other assets, relative to historical trends, relative to the monetary aggregates, and especially relative to the future amount of debt.
And gold is typically, known by people to be, boring or a pet rock. How can we make, gold sound more appealing or compelling or most importantly, cool like Bitcoin?
That's a great question, Ben. I think somebody on Twitter once wrote, "You guys are making gold cool again," and I think that's really something important. We had a big chapter about the image problem of gold in the West, where we said Western investors um, there is some sort of a narrative of skepticism, which is driven primarily by the media and also financial institutions. So we're seeing that, for example, in the Western world, gold is often being regarded as something for preppers and only the diehard gold bugs that actually hope for hyperinflation and civil war and something like that. Gold owners are rich tax cheats and Putin friends and unpatriotic and obviously also organized crime and stuff like that. those are pretty dominant narratives in the Western world. In emerging markets, it's completely different. And as I've said, the marginal buyer nowadays is clearly or has moved into emerging markets. But then there's also a second very powerful narrative, and this narrative is that gold is actually not green, that it doesn't fit the whole zeitgeist at the moment because it's basically useless and you have to mine it, um, and it's so dirty, and we try to come up with some good reasoning and explain why actually the majority of the gold miners are doing a tremendous job in producing gold in a very sustainable and a positive way. So I think we really, everyone in this industry has basically also the job to make a positive case for gold, to say it's something that has always worked over longer time frames to really protect and preserve purchasing power, and this is really what it's all about going forward. Um, we have to make the case that gold is actually very sustainable because it can be recycled. Um, so the carbon emissions of gold, for example, if you basically if you run the numbers, they're extremely low. We can also make a very, very positive case for silver being crucial um, for the solar industry. And I think that's important to do, and to that's we're trying to do that, and make like a positive case for gold. Try to make gold cool again for the younger generation, that obviously is more interested into Bitcoin and cryptocurrencies. But the thing is, you know, um, we all grew up, and we change. I'm listening to different music than I did when I was like 13 or 14 years old. Yeah, I'm dressing differently. And of course you change your spending and your investing behavior. So why shouldn't Bitcoin and young Bitcoin investors become gold investors in the future? Because you tend to get more conservative when you start a family, when you grow older, and I think that therefore Bitcoin investors could become future gold investors when they become older. So yeah. mm, long answer to a very important and very interesting question, Ben. Sorry about that.
I appreciate that answer. And you also spoke for just a moment there about silver. And I know that was also in your latest 2024 report. And so a question I had is like, is there right now a breakout or a fake out? What is all the technicals telling you guys about silver? And is this the golden moment?
Well, so far it has been a fake out. Um, Ben, I like drawing analogies, and I think there's some silver sometimes reminds me of some super talents in sports, where everybody said this is like the next Tiger Woods, this is the next Michael Jordan, this is the next Wayne Gretzky, whatever. But then it's for some reason, their careers haven't really taken off, and might be injuries, might be, I don't know, the money that made them go crazy. So sometimes silver reminds me a little bit of that, where everybody's saying, okay, this is the next big thing, and but then that nothing happens. And it also reminds me, my wife wouldn't enjoy this analogy of this ex-girlfriend that you're still somewhat interested in, and you still think of her, and you still kind of find her interesting. And silver is this thing where you sometimes think, okay, um well, let's give it another try. Let's see what happens. And I think that many investors got got seriously, they burnt their fingers investing in silver. But it also reminds me a little bit of uranium. We are running one uranium fund at Incrementum, and the fund manager, our colleague Christian Scherer, he made a brilliant case for the supply demand picture of uranium for a couple of years actually, but nothing happened. And then finally, momentum kicked in and the narrative changed. And then the price of uranium really took off. So something like that could definitely happen in the silver space as well. Now, just a couple of numbers or reasons probably. I had a look at the solar capacity that is being produced in India recently. And just in the month of March, India installed a record new solar capacity of 6.2 gigawatt. So they're basically nearly doubling the record for all renewables, which is according to a report by Goldman, I think. So in a single month alone, solar PV added nearly as much capacity as in the whole year of 2023. India is currently building a solar park that is 5 times as big as Paris. So the size of this is enormous. So I think that we could see up to 700 million ounces of silver being used this year just for the photovoltaic industry, while in comparison, the mine production this year will be roughly 825 million ounces. So I think it's first of all this enormous growth that we're seeing from green energy, especially photovoltaics. But then on the other hand, I think at some point there will be the time when investors say, well, gold is actually too expensive for me. Let's try the smaller brother. Let's try silver, which is still reasonably priced, and the gold silver ratio is still pretty high. So I think this combination could really be the trigger going forward. However, in the 2023 report, we analyzed how silver performs during recessions. And actually, it only starts performing at the later stage of a recession. So if your base case is that a recession is going to happen, then it's probably still a bit too early to get into the silver trade. So we are somewhat cautious at the moment. We are picking up some high quality names in the silver mining space, but I would say if a recession is gonna materialize, then silver will have a hard time and it will probably trade lower. But then when the reflation happens, and this is gonna happen, I've got no doubt about that, then I think that silver will finally start outperforming gold.
I think one final question I have is, you've been investing a lot of time in this space for a while, and I'm just curious to know, like, what is like the legacy that you really want to leave, for other investors or your family or your children? Like, why are you working so hard in, advocating for the gold space?
Well, the major reason is because I really enjoy what I do. I don't regard it as a job. I regard it as, my passion. It is something that I'm still highly interested in, where I'm learning every day, where I'm meeting great people from all over the globe. It gives me the opportunity to travel the world, attend conferences, speak to people. And I think, legacy is a big word. But I think it's those small moments when people approach you at a conference and say, hey, thank you. I really want to thank you from the bottom of my heart for the stuff that you're putting out and you're handing it out. You're making it available totally free of charge. I think if we can reach so many people from all over the globe and they start understanding gold and they protect their hard-earned money with gold, I think this is a pretty big thing, and this makes me super happy. And as I've said, all those emails and phone calls and messages that I get from readers, this is really fulfilling, and that tells me, okay, we're on the right path, and we're also having fun doing that. Yeah, so it's a great team. I really have to emphasize that it's not just Ronnie writing this report. There's 20 people working on this piece. Yeah, and all over the globe. Great young people, great talent. So yeah, I just really love what I'm doing. That's basically the secret.
Great. Well, I want to take this last little bit of time again to just thank you. Thank you for being here. Thank you for being back on the show. And thank you for everything that you do.
Thank you very much, Ben. It's been a pleasure. Appreciate it.